Hi CA students, let's revise CA Final AFM, Chapter 6 Portfolio Management, Practical Question 22. XYZ Limited has substantial cash flow and until the surplus funds are utilized to meet the future capital expenditure likely to happen after several months are invested in a portfolio of short-term equity investments, details of which are given below. Now investment 1, 2, 3 and 4 and the number of shares are given. Beta is given, market price per share and expected dividend yield. The current market return is 19% and the risk-free return is 11%. Now they are asking us to calculate the risk of XYZ short-term investment portfolio relative to that of the market. So they are asking risk of the short-term portfolio. So the risk of portfolio relative to that of market, which is nothing but the sensitivity of the portfolio towards the market's return. Now here risk signifies systematic risk. So beta is more relevant to the systematic risk. Hence we have to calculate only the systematic risk, which is nothing but the beta here. Okay. We should not confuse it with the standard deviation, as they have specifically told relative to that of the market. So sensitivity of XYZ relative to that market, sensitivity of portfolio relative to that market. Now for calculating beta we require now since we already have the beta of the 4 investments, we can take the weighted average. But here is the catch. They have given number of shares and then market price, and there are some dividend, expected dividend is given. Now we need to have a weight of the returns which we are getting from these investments, or else the weight of the shares also we can take. Now if we calculate the returns what we are getting, and then we need to multiply the shares with the market price, number of shares with market price, so that we'll get the market value of the share. Then on that market value, if we multiply with the expected dividend yield, we'll get how much dividend each investment is giving, which is nothing but the return which is giving the investment is giving us. That the proportion of this dividend return. So as we can see in the solution, the number of shares multiplied by the market share, then market value, then multiplied by the dividend yield will give us the dividend. Now the portfolio's total dividend is 2,46,000 and the individual dividends are given here. So the weight of individual dividends towards the portfolio is given here. This composition we can take for the portfolio of beta itself. Now multiplying with this composition we'll get the beta of portfolio. So they have also done the same thing. They have also calculated the return of the portfolio also. The return of the portfolio is nothing but total dividend 2,46,282 divided by 11,500. So which will give us 0.2238. So 22%, which is the return of the portfolio. Now since they are asking relative to that of the market, so the portfolio's risk, nothing but the beta in our case, relative to that of the market. So whatever beta we found out here is nothing but the beta of the portfolio. Now compare to the market, how much it is risky, that we have to find out. So we need to calculate this market risk implicit. So market risk implicit is nothing but whatever expected return we have got. So the expected return of the portfolio for the current market's risk. So that we have to calculate. Since we have the information of market return as 19% and risk-free return as 11%, using CAPM model, we can reverse work and find out the beta. Now what is this beta and what is the beta which we found out? So the beta which we found out is nothing but the weighted average beta of the portfolio which we have. Now as an example, let's say in the given case the first investment is having a beta of 1.16 and second investment is having an investment of 2.28. The same way each investment has different betas, different systematic risk, which is nothing but the relativity toward the market return. Now the company XYZ has invested in one proportion so that the weighted beta is 1.46, but we need to check based on the current market return and the risk free return comparing with the expected return which the portfolio is giving. So the expected return which the portfolio is giving, what would have been the beta risk? So that's what we found out here by reverse calculating using CAPM model, because CAPM will give us the expected return which we have already found out here, return of the portfolio, and keeping beta as the variable, we got 1.42. Now this market beta implicit, this market risk implicit is 1.42, while the portfolio's beta is 1.46. Thus the portfolio is marginally risky compared to the market. Why? This is because of the proportion involved in the portfolio. If they have taken the correct proportion, then we can reduce the risk to an extent of 1.42, but still the return which the portfolio of XYZ is giving 22.38%, that return compared to the market risk premium, so we are getting we should have got a beta of 1.42, but our current beta is 1.46, so the current portfolio is riskier compared to the market. That's what this market risk implicit signifies. That's what they have asked also. Calculate the risk of XYZ short-term investment portfolio relative to that of the market. Now here risk, as I previously told, it signifies only the systematic portion, and hence beta is used. Even standard deviation can be used, but there is no relative measure here because we don't know the standard deviation of market return also, and in case of portfolio, because of diversification, the standard deviation will reduce. So there are many things where we don't have the requirements. Thus beta is the measure which we are taking with the available information. Now whether XYZ should change the proportion of its portfolio. The second question they are asking, whether we should change the proportion which we are following right now. Now the decision regarding change of proportion may be taken by comparing dividend yield and the expected return as per the CAPM as follows. Now in these four type of investments, we have the expected dividend yield, and using CAPM model, if we find out one sorry, 1 minute. CAPM expected yield. So in our current case, this expected dividend yield is the actual yield, and we are comparing it with the CAPM's expected yield. If we compare, and then we can find out whether we should take what position in each of the case, whether that is overpriced or underpriced, or how we should change the proportion. Now CAPM we can calculate as we have the information of market return and risk-free return and beta in each of the cases. So substituting the beta, we will get the expected return. So in case of the first investment, it is 20.28%, and in case of the second investment it is 29.24, and in case of third it is the 18.20, and in fourth it is 23. So plotting this, we are getting 20.28, then 29.24, then 18.20, then 23. As we can see here, in the first case, CAPM is greater than expected return. So CAPM, this we have discussed in our previous videos also, so please check that once. If CAPM is greater than the actual return, if CAPM is greater than the actual return, then that signifies the actual return is earning less than the required return. So the actual return is earning less than the expected return, that thus it is overpriced. So the investors will not want it in the future, so the demand will reduce and they will end up selling it. Hence, it is overvalued stock. The action of us also is to sell it, because in future the price will reduce. Currently it is overvalued. Now, why it is overvalued? As we have seen, the actual return is less than what the CAPM is giving. Now in the second case, the second case also same thing. In third case also same thing. In fourth case, if we see, the expected return is more. So this signifies the investor who has invested in this is earning here 3%. So earning 3% more than what is required by CAPM. Hence the stock is undervalued. So more investors will want it. So the demand will drive up the shares until the expected return equals the required return. Till that point, the price is going to increase. So as we know the price is going to increase, current position of us should be to buy the shares. Now based on this comparison, so comparisons of dividend, as we can see in all these three cases, it will be to sell, sell and then sell, and in the fourth case it will be to buy. So comparisons of dividend yield with the expected return shows that the dividend yields of investment 1, 2 and 3 are less than the corresponding returns. So these investments are overpriced and should be sold by the investor. However, in case of investment 4, the dividend yield is more than the corresponding return. So XYZ should increase its proportion. So what they should do now is to reduce the first three investments and then to increase the proportion of 4. That's it. Thank you.